of trading accounts in the Forex. One is called a mini account, where with as little as $250 you can start trading at the $1 a pip level. And in the third phase, in the practice phase of our class, that's what we want you to do. We don't want you to demo trade. We want you to trade at the $1 a pip level, because you're going to take it more seriously. You're only risking $1, but whenever you trade real capital, your learning curve is going to be shorter, and you're going to take it more seriously because you're not going to bend the rules. That's why people always make money in their demo trading accounts, is because they put out larger stops, they stay in trades that they normally wouldn't, and so they're always bending the rules and trading in conditions that they normally wouldn't trade if they trade real money. When you're trading in your mini account in the practice phase of our trading program, the benchmark that we establish is to get 10 positive trades in a row before you move on to the next level, and that's trading at the $10 a pip level. To trade at the $10 a pip level, the minimum account size is $2,500. The average account size is $5,000. So with your $5,000 account, you can trade up to 5 lots. So the unit that we get paid in is called a pip. The value of the pip is $10. The unit that we trade in is called a lot. Requires $1,000 of margin to make a 1-lot transaction. Think of a lot as a share of stock. In other words, if you wanted to buy 1 share of XYZ, it's going to take X amount of dollars. If you wanted to trade 1 lot of dollar versus franc, it's going to tie up $1,000 of margin in your trading account. Once again, you're not risking that $1,000. You're only risking the size of your stop, and on average, we work off of a 10-pip stop. Now, in this marketplace, we only pay on entry. There is no exit fee or round-trip charge. That entry cost is calculated on the spread between the bid and the ask. The spread is always fixed. However, the range of the spread varies for each currency pair. These are averages. So the range of the spread for the 4 currency pairs that we're looking at today is between 3 and 5 pips. That's why I was saying when we talked about our yen trade here, I wanted to make it clear that we had a net 10 pips. In other words, the extent of this move from where our setup was to where it moved down was a 30-pip move. So we wanted to net out 10 pips. That was after transaction cost. So once again, the range of the spread is between 3 and 5 pips, and the range varies. So let's walk through what we call the 3 steps of trading, because remember, genius is the ability to make the complex simple, and trading is no different. Trading really distills down to 3 simple steps. Step 1 is we need to determine market direction. We know when we enter into a marketplace, that marketplace is doing one of 3 things. It's going up, down, or sideways. So step 1 is we need to determine market direction. Step 2 is we need entry strategy. And then step 3 is exit strategy. So for us, what I want to do here is let me go over here to the pound. We didn't get our confirmation there. Let me go to a little larger time frame here. This is the daily chart of the pound. This represents a little over a year of activity. This is the most recent activity here. We can see here from end of last year moving into spring of this year, we were trading in these conditions, and then price spiked up, then we were back in these conditions here. There was one little move here, and now we're back in these conditions here. And the point I'm trying to make is we can see here that your technology may have identified this one trending movement here and this one trending movement here, and this is why there's such a high failure rate, is because for this 6-month window, market was sideways. Here's another 4-month window. And that's why your stochastics, your Fibonacci values wouldn't have assisted you here, because the market's sideways 80% of the time. And so the life of a trend trader is stop out, stop out, stop out, stop out, stop out, stop out, and then market finally runs and moves in their direction. So for us, step 1 is we assume we're trading in sideways conditions. And so we identify what we call the trading zone. So let me just interject here as we come to close to the end of the presentation here. The purpose of today's free session is obviously not to teach an individual how to trade, nor would we go into every little detail of what it is we do in our trading methodology. It's to go into an overview of why training is so critical, why learning how to trade is no different than learning any other discipline, and to go into an overview of what it is we look for in a trading setup. And we did see a live trade. So first, step one is we identify what we call the trading zone. Then step two is we have our entry strategy. Now we teach two entry strategies here at the Trading Institute. The key is your entry strategy needs to be black and white. Most technology-based trading applications, 98%, use oscillator-based entry strategies. Some type of combination of moving averages or stochastics, MACDs, where you're looking for a crossover or hookover, and when this occurs, that indicates your entry point. There's two problems with this style of entry strategy. Primary problem is very hard to interpret, very inconsistent, a lot of false signals. As they say, all the stars have to align for it to be correct, and it's very cumbersome and difficult for people to consistently use this style of entry strategy because it's not black and white. It's always open to interpretation. Our entry strategies they're either there or they're not. They have to follow our rules. That's why I was waiting and saying I need to see the yen here give me what I call directional confirmation to confirm my entry point. So we teach two entry strategies. They're both black and white. The other thing is your entry strategy needs to get you in at what's called the beginning of a price move. By doing so, it allows you to use a tighter stop and then glean profit. Oscillator-based entry strategies get you into the middle of a price move, which requires a larger stop and then also forces you to stay in the market longer because you entered in the middle of a price move. So step one, we identify our entry strategy. Step one is the trading zone. Step two is our entry setup, which we got here earlier on the yen. And then step three is our exit strategy. Now here's the final pitfall of most traders. They believe the way that they're going to make more money is by being able to find the top and bottom of every price move. I see it all the time. Our trading system will allow you to enter into the market here and exit here. It has the ability to find the top and bottom of every price move. It's just not true. It's the holy grail of trading. Here at the Trading Institute, we teach what's called a scalping technique. Now, by pure definition, a scalping technique is an individual who is trading 40 or 50 times a day, looking for very, very fractional profit. We use the spirit of scalping. What we want to do is we want to scalp out the highest probability of each price move. Allows us to spend less amount of time in the marketplace. It's a proven formula of success that by evaluating what the size of the move is and taking a piece out of it, you're going to have a higher probability and a higher consistency of taking profit. It's a proven formula of inconsistency, constantly trying to stay in the trade for the top and bottom of every price move. And that's why there's such an inconsistency with these technology-based traders, is because they want to try to stay in the trade for the top and the bottom. They also believe the way to grow their account is by trading more often, when the reality is to learn how to consistently do it, and instead of trading more often, simply trade more lots. In other words, the euro moved in a roughly a little over a 10-hour period, about 120 pips. This is the top and the bottom of the move. $1,200 move. Took roughly 10 hours for it to happen. Our trading setup that occurred this morning at 8:10 this morning took less than 30 minutes, and on a 5-lot transaction we made $1,000. Less risk. We were in the market for a shorter period of time, and we knew that we could scalp out that high probability piece of that move. We don't want our greed to exceed our need. If we can consistently go for a piece of the move that we know is the highest probability piece of the section, it means we're going to consistently grow our account in a positive direction. It's those people that constantly want to squeeze out an extra 5 pips that then market reverses on them, then they try to stay in and get back to where they were, and then it starts to go even farther out, then they exit, then it comes back around, and they go through all of this psychological warfare in their brain. And if they just simply would work off of a fixed profit objective and cut their trading, they find they might be more consistent. The reality is working off of trading rules is a proven formula of success. So step 3 for us is we go for a fixed profit objective. So our trading setup that happened here on the yen, which we can see now has fallen even a little bit more, but what we wanted to do was scalp out the highest probability piece of the move. Once again, was based on strategies 5